Hi, my name is Stuart Weems and welcome to the Investopoly podcast. My goal is to share easy to understand, evidence-based, holistic insights to help you master the game of building wealth. And before we jump into today's episode, I just wanted to point out that I've been posting a lot of videos on YouTube. So if you spend any time there, maybe subscribe to our channel so you can follow those videos. And also podcasting's a bit of a one-way conversation. So I thought I'd try and open it up a little bit. And there is a link in the show notes to a YouTube video that allows you to ask me a question. So feel free to post your question in the comments of that YouTube video. And as I say in the video, I will record my response and answer, I should say. And, hopefully that gives us a chance to kind of interact with each other. Okay, so let's jump into today's episode then. And it's really about a little bit morbid perhaps, but, to what extent should you factor in an inheritance? Back in 2017, an Australian university estimated that Australians would pass on a staggering $3.5 trillion of wealth over the next 2 decades. And it's estimated about $10 billion is passed on to Australians every month, and it's steadily increasing. So given these projections, it's very possible that listeners to this episode will at some point receive an inheritance. And so it kind of raises an important question: to what extent should you factor this into your decision making? And if you should factor it in, how do you factor it in? How will it potentially change your investment strategy? So I guess my first comment is that planning, developing a long-term strategy, it requires us to make several assumptions about the future. And of course, predicting the future can be challenging at best. So our approach really is that we need to make sure those assumptions are conservative, but not so conservative that they become meaningless. You can be overly cautious to the point where the assumptions start to kind of become irrelevant. And inheritance are no different to this. So sometimes it's a personal decision about whether we include inheritance in a strategy, but personally, I kind of lean towards, in most circumstances, adopting a conservative approach, which is let's try and develop a strategy ignoring any inheritance. And if inheritance comes along, it's kind of a bit of a bonus. It's kind of icing on the cake, if you like. Now, if you do need to rely on an inheritance, of course, you need to then consider, the age and health of the benefactor, which is quite often, in most circumstances, our client's parents. And we've got to realize that the expected inheritance may actually not materialize, either because they've spent more than anticipated, unforeseen circumstances, poor investment decisions, living longer than expected, all these sorts of risks. Now, of course, it depends on the size of the estate as well and what it's invested in. So if you've got some parents that have a net worth of $20 million and it's all in cash and they're in their mid-80s and their health isn't fantastic, well, I think most people are going to assume that you're going to get some level of inheritance and probably several millions of dollars in that circumstances. But if parents are fit and healthy, and they've got a couple of $1 million of net worth and they're only in their 60s, well, it's conceivable that those people will live long enough to really utilize or need all of those monies. So it's kind of horses for courses. You want to be realistic, but by the same token, you also need to be quite conservative about it. As I said, general strategy is to kind of ignore it. Having said that, I thought it would be good to think about, well, how could it change your strategy? Because whilst you might not fully rely on inheritance, you might sort of keep it in the back of your mind, or really as a non-financial consideration, so you won't actually put it into the financial model to absolutely rely on receiving it at some point. But if you are in a situation where your parents are quite well off and there is a high probability of receiving some inheritance, then maybe we can kind of keep it in the back of our mind and maybe push ourselves to take slightly higher risk. And so I thought I'd talk about, what are some of the things that if you are in that situation that you might think about doing. So I guess the first one is, how much you spend on a family home and how much you need to really compromise in terms of the size or locality of that family home. For example, if we think, well, we want to live in a particular blue chip suburb, we know it's going to cost a lot of money. We need to borrow a lot, so we need to have a high level of non-tax deductible debt, and that's going to suck out a lot of cash flow over the next 10 or 20 years, whatever that working life looks like. And there is a potential risk that, by the time we get to retirement, we may not have fully repaid the home loan. Well, if our clients know that or are very confident that they're going to get an inheritance, we could say, well, if we haven't fully repaid the home loan, we'll sell an investment property or we'll take some money out of super. we have an answer to that problem in terms of how we're going to get rid of that debt. But most likely, if not by that stage, it's very close to probably receiving inheritance. And if there is, if our cash flow hasn't been sufficient in repaying the home loan, then we can use the inheritance in order to do that. And in that situation, maybe people feel more comfortable extending themselves a little bit further to get themselves into an area that is, really their number one desired area, even though it does give rise to that additional debt. Another way of sort of factoring to some extent inheritance is really overall debt management. So let's assume that we don't need to worry about the home loan. Either you don't have one or you're going to comfortably repay it before retirement. However, if you've borrowed to invest in property, typically what we like to do is make sure by the time the client gets to retirement, with that 60-65, that the property portfolio is neutrally geared. So that is, we don't necessarily want it to be giving us a lot of passive income, but we certainly don't want it to be generating large negative cash flows, because that's really just going to start draining retirement assets. That doesn't make us feel comfortable. So in order to achieve that, quite often what we need to do is allocate some cash flow towards notional debt reduction. In our mind, that is really putting cash in offset accounts to not reduce investment debt to zero, but get it to a point, as I said, that the portfolio is neutrally geared. Again, if we're going to factor in inheritance, maybe the change in approach would be, well, you know what, we're not going to be so focused on reducing investment debt because we've got 3 investment properties. And if push comes to shove, we can sell one and drastically reduce debt and keep the other 2. So in fact, we're not going to prioritize debt reduction. And also the other plan B is at some point we're going to get an inheritance, and that inheritance can help us reduce debt in the future. And so maybe then what we're going to prioritize is maybe have an extra few holidays over the next 10 years as opposed to being too focused on debt reduction. And finally, maybe we'll take slightly higher risk in a strategy if we know that there's a high probability of receiving inheritance. So again, it's not about necessarily relying on the inheritance either as a particular dollar value figure or putting 100% reliance on the inheritance. But for example, you might be, take higher gearing or have a more aggressive asset allocation, knowing that, that strategy in of itself is probably fine. It will probably work out fine, but also factoring in to some extent, maybe not in the financial projections, as I said, but keeping it in the back of our mind that, hey, there's a very high probability of receiving inheritance. We don't know if it's going to be $1 million or $5 million. We don't really care so much in terms of making the investment strategy work, but we know it's going to be significant. And because of that, we're quite happy to take a little bit more risk today in terms of our investments. And remember, risk isn't really about risking capital or risking returns. Risk is typically better described as potentially higher volatility. So that is, we're happy to sort of ride out those volatility bumps along the way because we know that, look, if we get to the point where we need to retire and the market has dropped 30%, we're quite comfortable because we've got these other assets that we can draw upon. And also we've got the cushion at some point in our life of this inheritance to sort of top us up. So that's really talking about, should you factor it into your overall investment strategy? Let's talk about if you're about to receive inheritance, what should you do? Because again, most people listening to this podcast episode are going to receive inheritance one day. So I thought I'd talk about 2 things. What should you do if you're about to receive an inheritance? And then secondly, what could you potentially do with those inherited funds? So I guess the first thing is it's going to depend on the size of the estate and the nature of the assets, of whether you need to go and get some financial advice, either from your existing financial advisor, or if you don't have one, you might need to find one. Again, it's going to depend on the assets that you're receiving. The first step that I will do is look at the will to see if there's a testamentary trust. I've spoken about testamentary trust before in this podcast. It provides some really good taxation benefits, and if it does provide for a testamentary trust or multiple testamentary trusts, it's normally something that we would want to utilize. The second thing you want to start thinking about then is taxation consequences. So if the estate starts selling assets, the taxation liability, so I'm really talking about capital gains tax here, rests within the estate. However, if the estate distributes assets to the beneficiary inherits the tax characteristics of those assets, so the cost base and so forth. So it's going to really depend on the type of assets that are in the estate, whether there's any carried forward income or capital losses in the estate, and the tax position of each of the beneficiaries, and then also the characteristics of each tax asset, and whether there's a testamentary trust. That's a long list of considerations, of course, but again, depending on the size and complexity of the trust, it's really about understanding the tax characteristics and really whether you should be selling down assets in the estate and distributing the cash, or whether you can separate the assets adequately between the beneficiaries and distribute them to the beneficiaries. The taxation considerations related to those decisions could be material, and that's something you might want to get some advice on, of course. Okay, so what might you like to do with these inherited funds? Well, if the assets are kind of surplus to your needs, so for example, if you've already financially secured your retirement, then you might look at those assets as kind of creating intergenerational wealth, so really for future generations. And in that situation, what you might like to do is then put all the assets in the testamentary trust and leave them in the testamentary trust for, as I said, for future generations. And you might be able to give, particularly in your will and also sort of handing over control of that trust, some instructions about what those funds are to be used for. So like a common one could be, all the assets go in testamentary trust and it's for grandchildren's education and great-grandchildren's education, depending on the size of the portfolio. Of course, you want to consider, how that portfolio is made up, if it's cash or whether it's shares, property and so forth, to make sure that it's well invested so that those future generations will have a sizable asset pool to kind of enjoy from. If those assets that come to you personally, or alternatively, if you haven't secured your own retirement, well, then the first thing I'd be thinking about would be how much can we get into super, especially given everyone can have up to $1.9 million in super and not pay any tax. So really between two spouses, that's $3.8 million. And if you're lucky enough to enjoy a large inheritance, why not try to get yourself to that level? So from 1 July 24, the non-concessional contribution limit increases to $120,000 per person. But also you can bring forward 3 years of contributions if you like. So let's say that you receive an inheritance after 1 July 24. What you could do on 30 June 25, so at the end of the 24-25 financial year, you make 120,000 contribution super. And then on 1 July 25, the start of the following financial year, you can then bring forward 3 years of contributions, which totals $360,000. So you could put in 120 on 30 June 25, and then on 1 July 25, put in 360 and essentially get $470,000 into super. And each spouse could potentially do that. So you're almost moving $1 million into super within a very short period of time. And that would be really tax effective to do that. And finally, another option could be to reduce debt, particularly if you're very highly geared or if you have non-tax deductible debt, so a home loan. It could be a good thing to put it towards debt reduction. Or in fact, you could be doing all three of those things or something different. I just thought I'd share some ideas, some common things that clients will do with inheritances. Now, in my experience, most adult children really encourage their parents to enjoy their wealth, particularly while they're still in good health. And most of my clients, if not every single one of my clients, is obviously taking active steps to secure their own financial future so they're not reliant upon an inheritance. However, despite these efforts, receiving an inheritance is still a high probability for most people, and therefore it makes sense to consider, what would we do differently today, knowing that whilst we don't necessarily want to rely on it, knowing that the most likely outcome is we will receive an inheritance one day. Okay, so thanks again for listening. Really appreciate it. If you like the podcast, please leave a rating. Please share it amongst family or friends or anyone you think might get some benefit from it. And until next week, bye for now.